Welcome back. As promised, we have Pankaj Murarka joining in now. He's the founder of Renaissance Investment and he's going to help us wade through this market. It's the fag end of the year, Pankaj. So greetings of the season to you. What a year it's been. I mean, a rollicking ride both ways. And a couple of trends have stood out, right? Whether it is going short on IT, going long on banks, going long on defense names. What do you think would be the top 2 or 3 trends of 2023?
Well, first of all, greetings to you and all your team and all your viewers. I think, Sonia, coming back to the point, I think just to put things in perspective, last 2.5 years post-COVID has been more about macro tailwinds, where we've had significant macro tailwinds globally and locally in terms of low interest rates, fiscal expansion, central bank pumping in money, and so on and so forth. This year has been a year of transition where we've had significant rate hikes. And I think next year is going to be a year about macro headwinds because the cumulative rate hikes that we've had this year will have an impact on growth next year. And most of the governments across the world are on a path of fiscal consolidation. So those low-hanging fruits are not there. If the world is going to be an environment where we face macro headwinds, then I think what really works well in this kind of environment is companies which have very strong or robust business models. And it's going to be all about bottom-up stock picking. So in that context, I think it's not about sectors or themes, but it's more about specific companies and bottom-up stock picking, which is what the next year is going to be.
Pankaj, morning. So what are some of the latest ideas from Renaissance Investment Managers?
Well, one, we think pharma as a sector can really do well next year because it's been a sector which has been underperforming for the last 2 years. And we think we've reached a stage where the entire sector's profit pool will probably trough out this year because the sector is having negative earnings growth for the last 2 years. We think all of those headwinds are behind and probably next year onward, the sector will start delivering healthy earnings growth. So that's one sector we really like in that sense. Also, at some level, we think that this year started with a lot of euphoria and expectations out of some of those internet companies which got IPO'd early part of the year. We've seen significant valuation correction, price correction in that space. So we like some specific names in that space as well because we think underlying growth in internet businesses continues to remain very strong, not only next year, but even from a medium term to longer term perspective, and valuations there have moderated significantly.
Okay. Hi, Pankaj. Morning. So you were saying that you like these internet companies. I know Paytm is on your list. So take us through the rationale there. And anything else you like from this space, the likes of Nykaa, Zomato, anything else from the new age companies that looks exciting?
Well, one, at a broader level, we are excited about the whole internet ecosystem because our belief is that India's overall internet economy, which is just about $100 billion, can grow 2x the underlying economic growth or GDP growth, and probably it can become $500-600 billion over the next 7-8 years. So obviously we like everything. We like the sector as a whole, and we're looking at all of these businesses. Coming back to Paytm, yes, we have ownership there, meaning the idea behind Paytm is very simple. I think payments, as the economy grows, payments and digital payments will keep growing. And now they've started making money out of their core business, which is the digital payments business. And more importantly, they are leveraging their customer base to cross-sell other products to the customer base. So I think our view is probably they should turn cash flow positive probably by the end of this year. And given the significant size and scale that Paytm and many of those internet businesses have built, once they get profitable over a period of time, they're going to generate significant amount of cash flows. So we think over a period of next 2 to 3 years, they can churn out significant amount of free cash. And that is actually, to my mind, not priced into the current pessimism that's prevailing in the stock.
Okay, by the way, the market is now at the low point of trade. It's given up on that 18,100 mark as well, down over 105 points. So don't lose sight of what's happening there. I wanted to just quickly point out a couple of brokerage views on cement that stand out today. Kotak put out a note on cement where they say they're very bullish on the cement space. They talk about how prices continue to see a nominal uptrend in December. There are sharp price hikes that have been taken in the east part of the market. There's about a 1.5% quarter-on-quarter hike, and not just prices being hiked. There's also softness in petcoke and thermal coal prices, which should ease cost pressures for them. There's another note that DAM Capital has put out on Ultratech Cement, and they have a target price of 8,200, which is quite a big upside to the current market price. They say the entire cement industry is entering into an upcycle, and this is led by pre-election demand and uptick in real estate, manufacturing as well as capex, and they expect a compounded volume growth of over 10% in the next couple of years. Pankaj, very quick thoughts on the cement sector. Would you buy now? And if yes, what would your top picks be?
Well, I think the point remains that demand is going to be seasonally strong over the next year because one, we are seeing strong uptake in real estate and core sectors. And apart from that, the pre-election public expenditure should drive that. Our preferred bet in the sector would be, we generally tend to go with sector leaders. So preferred bets for us would be Ultratech in that sense.
Pankaj, out of time, but thank you very much for joining in. Need to slip into a very short break. On the other side, we'll get you more on the market.